Hello, in this video we're going to cover taxes. So we're going to be talking about, and primarily income tax is going to be our focus, although there is some sales tax and there's some other taxes. Primarily we're going to be talking about income taxes. Okay, so let's get started. So in this chapter, we're going to talk about what a tax is, how our projects around the city and around the federal government are funded via taxes. We're going to learn about what the progressive tax system is. We're going to learn about a little thing called capital gains. Now, capital gains is amazing because you pay a lot less in taxes. But you have to earn income a certain way rather than a traditional going to a job, getting a W-2 type thing. And then finally, we're going to talk about a couple different things that you can do that can reduce your taxable income, save you some money. All right, so let's get started. This is our vocab word today, and taxes are really... This is what we're paying for membership in this society, right? I mean, to get our roads paved and taken care of, for our parks, for the police force, for the fire, all of those types of things are our taxes. Okay, so let me ask you this question. If you were to make $5,000 a month, what is the appropriate amount that we should pay in taxes? I want you to think about that just a little bit. You kind of just think those through, and I'm going to share with you what our actual tax amount is. So let's talk about that, okay? But just think, $5,000 a month, what would be the appropriate amount you think someone should pay in taxes? All right, let's look at what it is. Okay, so here, $800 alone in just your federal income tax, and you have some state taxes, you've got property taxes, sales tax, payroll, I mean, you got a lot of taxes there. That's about a little over $1,700, $1,750 basically, in taxes off of $5,000 in income. That is a lot of money going to our taxes. Okay, let's talk just a second for what, the average person pays. I mean, the average person pays roughly a third of their income is going to taxes. That is a lot of money, okay? But that's kind of just the average American. The rich, if you will, the rich pay a lot more than 1/3. They pay the highest amount in taxes. And the poor, those who don't make a lot of money, many of them do not pay any sort of federal income tax. There are some other taxes. They pay sales tax on goods that they purchase, property tax in the place that they're living. If they don't own a home, they're paying it in their rent, essentially, okay? Next vocabulary word, this is the IRS. This is the government agency that is tasked with enforcing whatever the tax guidelines and policies are. Okay. All right. What are some items that are funded via taxes? Think about that for a little bit, okay? What are some government agencies or government programs that are funded with taxes, whether that, we've kind of talked just a little bit about police and fire, military, all of that. And some other things maybe that you didn't think of right away that are also funded by taxes. I mean, the national debt, that's like a third of our budget that we have is paying interest. Isn't that crazy? It's amazing if we didn't have that national debt, how much more we could accomplish, or how much lower our taxable amount would be, giving more money to our citizens or our taxpayers that they can use how they see fit. But right now we have that national debt, and it's huge. Social Security, healthcare programs, politicians, right? I mean, they have a salary, they earn an income. So our taxes go to pay for them, right? All right. In our system here in America, we have something called a progressive tax system, meaning that the more income that you make, the higher the percentage that you're going to pay, and the more total dollars that you're going to pay, okay? If you are wealthy, the society that we live in has deemed it necessary for you to pay more money than someone who has less wealth. Now, right or wrong, wherever you sit on that, that's where we're at, okay? I do think that we're overtaxed. I think that we need to cut down the amount that we're taxed, especially our wealthy. We need to cut their tax so they can pump more money into the economy. They're going to have a bigger impact, okay? And a wealthy person... And we'll go through this. We'll go through this in just a little bit, and we'll kind of talk about that. But anyway, it's a progressive tax system. Here are the tax schedule, okay? Here's how much you make, and here's how much you're going to pay in taxes. All right. And this gets to be quite a bit here, okay? A lot of information all at once. Here's what I want you to focus on. I want you to focus on this single, right? Hopefully, as you're watching this, none of you in my class are married yet. So you're single. So here's your tax structure. If you make between $1 and $9,875, you're going to pay 10% in taxes. You make $5,000, you're going to pay 10%. That's $500 in taxes. Okay, sort of. We'll get to some deductions a little bit later, but so that's your tax code. Okay, if let's say you make $10,000, your first $9,875 that you make will be taxed at 10%. The other $125 that you make, right, the difference between $9,875 and $10,000, that $125 is going to be taxed at 12%. Not the entire thing. So your entire income is not taxed at 12%. Just the amount that exceeds $9,875. And this gets really confusing. I would say probably the average American, probably 80% of the average Americans, or 80% of Americans don't understand this aspect. And some people will go, well, you know, my work offered me a raise, but that's going to put me into a higher tax bracket. So I told them no. No, that's not what happens. Only the amount that exceeds the previous limit is taxed at a higher rate. Everyone in the United States, the first $9,875 they make is taxed at 10%. Okay, Jeff Bezos, his first $9,875 is taxed at 10%, just like you and me. It's no different. Then the next, between $9,876 all the way up to $40,000 basically, is taxed at 12% for everyone across the board. So if you're a millionaire, you're still paying a 10% tax on the first basically $9,875, and then you're going to pay 12% tax on the difference between $9,876 and $40,000 basically. And so it's just, it progressively gets higher. So we're talking about our millionaires. Our millionaires are down here making paying 37% in taxes. They are paying a lot more in taxes than what the average person is paying by far. I mean, an individual who makes less than $10,000, let's say they make $9,000, is paying 10% in taxes. Someone who's a millionaire is paying basically 4 times that amount, 37%, 3.7 times that amount. 37% in taxes. That is a lot more than someone who's making only $9,000. And you may be saying, well, yeah, sure, they can afford it. Okay, why? Why do they have to pay more? Just because they can? So you want to just kind of be thinking about that as you go to vote, and you can determine who you're going to vote for, at least on tax policy. I mean, it's crazy to think that we're charging one individual almost 4 times what we're charging another individual. Oh, and that's just the percentage. The dollar amounts get really crazy, right? The vast majority of our taxes are paid by the wealthy. I'm never a proponent of taxing anyone any additional amount. If anything, I think we need to reduce the taxes across the board, but especially on the wealthy. So anyway, that's my personal opinion. Okay, let's look at a scenario here, okay? I've got 2 individuals, and I'm still going to be using this tax schedule. So I've got 2 individuals here. Jarius makes $50,000 a year, and Nathan makes $100,000 a year. And I'm just going to go through, and I'm going to detail how much they're going to pay. And I'm still going to use this. So the first $9,875 that both of them make is going to be taxed at 10%. All right, so Jarius makes $50,000. So that first tax bracket is taxed at 10%, right? $987.50. With the IRS, they do round to the nearest dollar, so that's why I have $988. Okay, so the first amount there is taxed at 10%. And then between $9,876 and $40,125, that portion is taxed at 12%. Only that portion, okay? So notice it's not 12% of the total, just that portion. And then between $40,126 all the way up to $50,000, that amount, only that amount is taxed at 22%. So you'll notice here, it's actually broken down into 3 different categories that Jarius has to pay. Now, his total taxable amount, in order to get that, we have to add all 3 of these. So I'm going to add up all 3 of these. His total taxable amount for the year. Now, this is just federal income, not state, not anything else, just federal income tax, is $6,790. Okay, well, Nathan makes $100,000. And again, first of all, why should Nathan pay more than Jarius? If Jarius is paying $6,790, why would Nathan pay $7,000? It seems weird to me, you know. But let's go through this scenario. So the first $9,875 that he makes is taxed at 10%. Okay, everybody across the board has done the same. Then the next portion, you notice these here are exactly the same. They have not changed at all, not one bit. Okay, But here's where it's going to start to change, because Jerry has stopped at 50,000 and Nathan is going to be making up to 100,000. So we need to continue to go. So the 22% tax bracket goes all the way up to 85,525. And then finally, he's in the 24% tax bracket, anything between basically 80,000 and 100,000. Now to get Nathan's, we must add up all of Nathan's. Okay, so as we add up all of these together, Nathan, and some of you may be saying, well, he should pay twice as much because he makes twice as much. To me, that's ridiculous. But even if you say that, well, look at Nathan. He paid almost 3 times as much. He's paying a really hefty tax bill in comparison to Jarius. And the reason is because he's ended up paying this extra $50,000 that he made is taxed at a much higher rate than what Jarius's initial $50,000 was. So yes, he's paying a lot more, and that's the way our structure is set up. The more money you make, the more money you're going to pay in taxes. Just for clarification, this is based on the 2020 tax code. If we went back to what the tax code was under Obama, it would have been, Nathan would have paid $21,000 in taxes. During Trump, he cut the taxes, and so the amount that Nathan has to pay in taxes is going to be less. Same thing with Jarius. His would be less. His would be a different amount because he makes a different amount. So, all right. So just crazy to me, but that's essentially how our system works. It's called a progressive tax system. As you progress up, you pay more interest or more of a percentage of your income. All right. Now, we've kind of brushed on that, just very, very basic. Okay, single, and we could go back and look at that big, long spreadsheet that has it all in there. Single is basically you're single, right? You're not married. Or you're separated. There are some instances you can do that. Married filing joint. This is an individual like my wife and I. We are married. We file a joint tax return. We combine our 2 incomes. We combine our 2 deductions. We make that all in one tax form. So the 2 of us file one tax form. Married filing separate, that means we file separate, right? Most of that, there used to be what they call a marriage penalty tax. If you're married, they actually charge you a higher tax rate. They have done away with most of that. It still exists at the very, very high tax levels. So if you have 2 individuals who are married and each one of them are making $1 million a year each, it's actually better for them to file separately rather than a joint tax return. But typically, if you're making less than that, a joint tax return is equal to a single filing singly. So anyway, head of household, this basically means you're on your own. You're no longer with mom and dad. They're no longer paying for you, or maybe it was just mom, or maybe just dad, whatever your case may be. But now you're on your own, so you're considered head of household. And a widower, that's of course if your spouse recently passed away and you still have a child at home. Okay. How taxes are collected. So what happens here, and I'm going to talk about this toward the end of this video. I'm going to pull up a paste it. And the federal government has said, well, if we just send people a bill on what they owe on taxes at the end of each year, that's a pretty substantial amount, and they might get pretty angry with us. And they understand psychology, the federal government does, so they say, okay, instead of charging them once at the end of the year, why don't we do this? Why don't we just have them make payments throughout the year? So that's what we do. We have what we call a pay-as-you-go system. Basically, you get your paycheck, and taxes are automatically taken out in your paycheck every single time you get paid. And so this way it doesn't feel like such a big burden on you. But look at it as you file your taxes at the end of the year. It is absolutely crazy how much money you're paying in taxes. And then you can decide whether you believe that's an appropriate amount. For those of you who disagree with me and think that you should pay more money in taxes, I totally encourage you to pay more money in taxes. That's fine. Go ahead. You can do that. I just don't want you to take it from me or from someone who doesn't want to pay it for a federal program that is ineffective, right? We should have some say in that. Anyway, so they take it out of your paycheck every single time you get paid, including federal, state. They do Social Security, they do Medicare. We call that FICA. We're going to talk about that as we go through our pay stub at the end as well. Okay. So this is our FICA. 7.65% is how much is taken out of your paycheck if you work for somebody. And let's just figure out how that breaks down. Okay. 1.45% of that is Medicare. This is basically, if you want to think of health care for older people, okay? You've got to be, I believe it's 62 before you can start it, and it basically pays for them. You are paying for the individuals who are currently in the system. So essentially, you're paying for your grandparents to receive Medicare. Okay, this isn't something that your grandparents have put in all this money to, and it's been saved for them so that when they need it, they can withdraw that money. That's not how this works. Okay, it is money that you are putting in that is being withdrawn by your grandparents to pay for their fees and costs. Same thing with Social Security. Only difference is it's 6.2%, but Social Security, you are paying that in right now, and that money that is received from you is paid out to the individuals who are currently receiving benefits. So again, you're paying in for your grandparents. Now, if an individual decides to do that in their private life, it's called a Ponzi scheme. It's illegal. They can't do that. Okay, that's what like Bernie Madoff did. You can't take money from one group and then pay out to another group with the promise that you will pay the group later on. All right, you can't do that. But this is the federal government, so they say it's okay. So this is their exception. They are the ones that make the rules, so they get a little bit. So they get exceptions. So here you go. But this is how Social Security is done right now. There are people who say, well, is Social Security going to be around when you retire? And there are people who say, no, it's not. It's going to be bankrupt. Here's my personal opinion. It's going to be around. It will be there. There will be that benefit. The individuals, you right now are putting money in. The highest voting block in America is elderly people, older people. They're not going to take money away from the highest voting block in America. It's just not going to happen. So yes, it will be there. I'm not a fan of Social Security. I don't think it's a good investment. I would rather take that 6.2% invested in the stock market, have my own retirement fund set up. We would be so much better off. But that is the way it is right now. Okay. And you have to pay Social Security until you reach a certain limit, and that limit changes. This limit here is based on 2020 taxes, so 137.7. So if you make as soon as you make 137,701, you no longer pay Social Security. So if you're making 150,000, you pay Social Security on the first 137.7 that you make, and anything in addition to that, you do not pay Social Security on. Remember that you pay that and your employer matches it. So at Heritage, I pay 7.65% and Heritage pays 7.65%. Okay, so if you are self-employed, congratulations. You are the employee and the employer. You have to pay double. So you must pay, that's 15.3%. So if you're looking at starting your own business and being your own boss, you can just understand that you have to pay double of what we call those FICA taxes. All right, capital gains. This is your opportunity to avoid some taxes. All right, I'm going to tell you about this. This is basically when you buy and sell an asset. And specifically, it's used most of the time when we're talking, it's stocks, right? You buy a stock for $100, it goes up to $150, and then you sell it. You made a $50 profit. That's considered a capital gains. Okay, here's our big loophole. You ready for this? Not really a loophole. It's 100% legal, okay? But it will reduce the amount that you pay in taxes. Here is the tax brackets for capital gains compared to the traditional tax bracket. Okay, so over here on the left, this is our traditional tax bracket. That's one we just talked about, right? The first $9,875 that you make is taxed at 10% all the way through, right? Okay, now, if it's a capital gains, so if you're making your money by buying and selling stock, they tax you at a different rate. Let's look at this. For capital gains, the first $40,000 that you make is taxed at 0%. Crazy. Okay, so if you're earning your income by buying and selling and investing in stocks, and that's how you make your income, congratulations. The first $40,000 you make, you pay zero in taxes. Zero, not a dime. Then from $40,000 all the way up to $441,000, you pay 15%, and then anything over $441,000, you pay 20% in taxes. And here's really how Jeff Bezos makes his money, how Elon Musk make their money. They are paid a traditional salary, of course, but the vast majority of their money is paid in stock options. So when they exercise those options, that option is taxed at a capital gains rate, not a traditional W-2 rate. And so, of course, they're making billions, so they're going to be taxed at this 20%. 20% is still an absurd amount for how much money they're making, but 20% here is much less than this 37% that they would pay through normal wages. So if you can classify money and you can earn your money by investing in stocks, and it could be different things too. You could do it in real estate, that type of thing. But there are some caveats I'm going to tell you about in just a moment. But if you can make your money there, you're going to pay a lot less money in taxes. So it's a fantastic way to reduce how much you have to pay in taxes. Okay, so you start to see the benefits here of investing. You know, we're talking about saving money on a regular basis. There are some major tax benefits as well. Okay, Remember our previous example here, right? We did Jairus. Let's just take one of these two. We talked a lot about Nathan. Let's talk about Jairus for a moment. Jairus was $6,790 is what he paid. Okay, that was normal traditional income. If we changed it and Jairus made all of his money via investing and these capital gains, and all of his money was classified as capital gains, instead of paying $6,790, let's take a look at how much he would have paid, okay? All right, he still made $50,000. The first $40,000 that he made, though, was taxed at 0%. He had to pay no tax on that whatsoever. He just has to pay the tax on between $40,000 basically and $50,000. And that is taxed right here at 15%. So he's going to pay $1,500 for it. His total taxable amount is $1,500 in taxes. So if you're asking me, would I rather pay $6,790 in taxes, or would I rather pay $1,500? I'll take the $1,500 every single time. So yes, if we can classify our money and we can change the way we make money as investments instead of traditional income, we can really save a lot of money. Okay, a couple things you got to be aware of. These are the caveats I was telling you about. Number one, you must own it for at least a year. In other words, if I buy it this morning and I sell it tomorrow, I do not get capital gains. I have to own that asset for at least a year. A year and 1 day, basically, is what they're saying. So, okay, if you make $600,000 and you own the stock for 15 months, you're going to be taxed at that 20% rate. If you make $600,000 and you've only owned the stock for 11 months or 1 day, it doesn't really matter. Anything less than a year, you are taxed at 37%. They consider that like a day trader. That is all taxed at a higher normal income rate. Okay, so you don't get any tax deduction. It's specifically designed for people who want to invest, so to have that investing money. So that's the other thing you've got to be aware of there. And this one, I just want to make you aware of this. I've preached in this class a lot about investing in stocks, and let's just talk about why. So this is $100 invested, right? We started with $100 before the stock market crash of 1929. Okay, so $100. How much has that grown over? Let's see, 90 years. 90 years. How much has it grown? Stocks have the highest return by far. Normal inflation is $1,300. Stocks, $726,000 is what that $100 would be worth today. Isn't that crazy? $726,000. So this is why I'm telling you to put your money into stocks, because you do get the capital gains reduction, and it's the best performing asset investment that you can get, with a couple caveats that are really, really crazy. This is for the everyday person. Just put your money in the S&P 500. This is what you will get. This graph was provided by Fidelity. They've got a nice system in there. I do like Fidelity. Not the only one that's good, but anyway. I just want to make you aware of that. All right. Types of income. You can have income from just about anywhere. Anything that you get money from is considered income, right? Wages, your normal. Bonuses. Tips, if you're a waiter or a waitress, you get tips. That is considered income. It is taxable. Interest or dividends, of course, that's going to be. But those are taxed at the capital gains rate, so much better. Alimony received. So if you went through a divorce, that's alimony. And kind of like child support, where you pay to support your child, this is spousal support is what they call it. It's paid to pay a spouse to help support a spouse. So if you went through a divorce and you received alimony, you have to claim that as your as taxable income. If you win the lottery, that's taxable. If you win a prize, you have those ones. You maybe at a golf, and if you hit a hole in one, then you win a free car. You do, but it's considered income, and you will have to pay taxes on that. If you're at one of those shows. Ellen does it sometimes, or Oprah used to do it, where they'd go, everybody gets a car. Everyone in the audience got a car that day. Great, you get it, but it's taxable income, so you're going to have to pay taxes on it. Now, it's still better than not taking the car. Still take the car. It's worth more than what you're going to pay in taxes. You can always just sell the car the next day type thing. But all of these things are types of income. Federal income tax is based on your income minus any sort of deductions that you have. So let's figure out how we can reduce this amount that we're going to owe. So again, we take all of our income here and we're going to reduce it by these items. These are the items that can reduce how much you have to pay in taxes. College costs. Now those are somewhat limited, but you can write off what you're paying for some college expenses. IRA contributions, these are individual retirement accounts. Contributions to IRAs will reduce your taxable income. Alimony paid, so if you are the one that got a divorce and you have to pay your spouse alimony, that can be reduced in your taxes. Mortgage interest, so if you own a home, that's going to reduce the amount you have to pay in your taxes. If you give money to charity, now we've talked before in this class about charity. I'm a big fan of charity. I think you need to give 10% of your income to charity. And as you give that 10%, that is a deduction in your income, taxable income. So that will reduce the amount you have to pay in taxes, which is really nice. It's the federal government's way to encourage people to give to charities, okay? All right, standard deduction for this year. Now this means if instead of going through all of these and itemizing every dollar that you gave to every person, if you want to just make it easier, the federal government has said, okay, instead of doing that for everything, if you want to just take a standard deduction, we'll give you $12,400. So that means if you make $15,000, $12,400 comes off of your amount that you have to pay in taxes immediately. Meaning you're only left with $2,600 that you have to pay taxes at, and that's at the 10% rate. So that's pretty good. So instead of doing all these itemized, you can just take $12,400 immediately. If you make less than $12,400, know that you will not have to pay one dime in federal income tax. Okay? You will have to pay Social Security, you will have to pay Medicare, but you will not have to pay federal income tax. So whatever you've paid into that in your weekly or biweekly paycheck, you will get that money back, okay? All right, so let me pull up a pay stub. I'd like to do that, okay? Let's pull up a pay stub right now. Okay, this is a sample pay stub. Okay, and you'll go through here. It's got your statement on it. Pay usually covers about a 2-week period. Here's your pay, right? Your regular pay. If you get any overtime pay, if you ever get the opportunity to do overtime, do it. It's time and a half. You get 1.5 times as much per hour as you were getting before 40 hours. So if you ever get the option, do that. But here's where your federal income tax comes out, $298. Social Security is $68. And this, they just take it right out of your check. So your gross amount, you made $1,000 on this sample pay period, but your ending check, your net pay is $583. So the rest all went to taxes. Now, if throughout the year, that's all you made was $1,000, then you would get this $298 back in federal income taxes because that's under the $12,400 figure that we just talked about. But otherwise, you're going to pay that in your taxes. This is going to be your net pay. Everything else on this one is essentially going to the government, except for 401k, which is a retirement plan. 401ks, I'm a big fan of those. But anyway, so this is just kind of a sample pay stub. So hopefully this was a little bit beneficial. It's a crazy system that we've got, but it's one that you need to know so that you can reduce the amount you have to pay in taxes.